Today, we're going to talk about a financial concept that's often praised when it comes to growing wealth compound interest. However, there's a side to compound interest that isn't discussed as much, and it's how it can work against you, especially when it comes to debts like credit cards and loans. Now, seasoned investors love compound interest because it allows their money to grow exponentially over time. When you invest money the amount you earn, interest gets reinvested, which in turn earns more interest, and this cycle continues leading to your money. Snowballing over time, it's a fantastic tool to build wealth, especially for you who are starting early in your financial journey. However, the same magic that works for you when you're earning interest works against you when you're being charged interest, particularly with debts. For example, let's take a look at credit cards. Many credit card companies charge interest on a daily basis. So when you carry a balance on your credit card, not only are you paying interest on the amount you owe, but you're also paying interest on the interest been added to your balance set from the previous day. This is where compound interest turns from your friend to your foe. Also, understanding the terms associated with your financial instruments is crucial. For instance, knowing the annual percentage yield or APY and the frequency at which interest is compounded is important to know. It helps you understand how much you'll be earning or owing over time. Now, for loans like school loans and auto loans, it's a similar scenario. If you have a loan that compounds interest daily or even monthly, the amount you owe can grow rapidly, especially If you're only making small or minimum payments over time, you could end up paying back significantly more than you originally borrowed. This is why it's so important to pay down high-end debt as quickly as possible. One of the key takeaways from the experts is that when you're in a position where you're paying compound interest to others, the financial disadvantage can be substantial in the current interest climate. Credit card issue or always have the upper hand because they can compound much higher rates on a daily basis compared to other financial instruments. It's like a financial hole that only gets deeper the longer you stay in. It's a what can you do to combat the negative effects of compound interest? Well, a good starting point is to focus on paying down high interest debt and avoiding carrying a balance on credit cards, also when considering loans or other forms of credit. Pay close attention to the interest rates and the compounding frequency. Making informed decisions can save you a lot of money in the long run. While compound interest can be a powerful tool to grow your wealth, it can also work against you when it's debt. So it's crucial to have a solid understanding of how compound interest works in different scenarios to make the most out of your financial situation. And remember, the sooner you tackle that high-end debt, the sooner you'll free yourself from the downside of compound interest. So get out there, tackle that debt, and set yourself up for a financially stable